Do you want better trade entries or smaller mistakes? A lot of traders chase the ideal entry, but it's the math that determines who's going to last and be profitable over time. So it may not be a chart problem. I'm Dean Jenkins from Follow Me Trades, and in episode 1 I talked about the quicksand math of drawdowns. In this episode I'm going to talk about how that can happen and some things we can do to prevent it. And more often than not, the key thing is position size. I've talked to hundreds of traders over the years, and I've heard something consistent in their trading rules, and that is, hey, I take the same size trade, I put the same amount of capital into a trade every single time, and then I use a fixed stop, a fixed percentage stop. That may sound disciplined, but it's actually completely disconnected from the realities of both what's going on the chart on price action and the account size. So I'd like to offer 4 simple steps to determine the correct trade size. It uses basic math, but it has the power to completely change your results without changing your charts or your setups at all. So step 1 is to define the exit point on the trade, on the chart. And we do that without thinking in terms of percentages, if it's down 1% or 5% or something. It's looking for a price level on the chart using the time frame you trade in and whatever indicators or analysis you already use. You want to ask yourself this important question. At what price level on the chart would my original reason for taking the trade be invalidated? And you can use price patterns, reversals. You can use support levels, resistance levels, indicator values, whatever you're using. But just that, without regard to a percentage move, go, if I look at this chart and I think this thing's going to do this, at what price level would that be invalidated? And that's your exit price, because you want to get out of the trade then when it's been invalidated. And that's your stop. And it doesn't imply that you have to have a stop market order. However you want to manage the exit is up to you, but it's important to have a predetermined exit on the chart, a price level where you say, I'm out of the trade. It has failed at this price level. So that's step 1. Step 2 then is you define the risk. And by that I mean you take that stop price and you subtract it from your entry price. Wherever it is you're going to enter the trade, and you've defined your exit, and the difference between those is your risk. The potential loss per share, per contract, whatever it is you're trading, it's the same across all instruments. Okay? You simply define the potential loss per share per contract. And for example, if your entry price on a stock's $40, the exit you've determined is 38, then 40 minus 38 is $2 per share risk. Okay. Then you define your acceptable loss. You decide how much of your account, right? Not what percent of the trade, what percent of your account are you willing to lose on any given single trade? I use 2%. So an example, if you have a $10,000 account, 2% of that is $200. So you'd say, I'm not willing to lose more than $200 on any given trade. And 2% for me isn't arbitrary. It comes from the risk of ruin math. Some pretty neat statistics that determines whether a system survives, variability and a normal losing streak. You need to determine your risk tolerance, but you have to determine it. And then you determine your position size. You divide the acceptable loss by the loss per share or contract, and that tells you how big the position can be. For example, $10,000 account, we've defined a 2% risk, that's $200. entry's 40, exit's 32, risk per share $2. We divide the $2 risk into the $200 max loss, and that says 100 shares for this trade. Okay, so that's not a fixed trade size, right? And it's not a fixed percent move from the entry. It's a fixed amount of loss based on the chart and my account size together. We let the math determine the position size. Okay, to recap, define the exit, define the risk, define the acceptable loss, and then define the position size. This anchors the position size to both the realities of the chart and the account size, with risk as the fixed value. And here's something that many traders miss, is that trade size is quite often about fear. What do I mean by that? If you're taking very, very small trade sizes, it typically indicates that there's fear before entering the trade. I think that would make sense on its own. A large trade size can create fear during the trade. So, wow, I could lose a lot of money here, or even if it's a win, there's a lot of stress induced. So a large trade size can create fear during the trade. The correct trade size can minimize fear because the worst case has been completely defined and accepted, but there's reasonable upside to make the trading, potentially profitable and worthwhile. So there's this timeless trading wisdom. You've probably heard some version of this. People talk about it, about cut your losers early, let your winners run. It's timeless. It's good stuff, right? But the wrong position size will undermine this. The correct position size enables it. So I want to, wrap up the slide here by saying, having a trade lose isn't a problem. In fact, it's inevitable in trading. So we shouldn't view it as a problem. Right? Having a very large loss is a disaster. And that can lead to that quicksand of drawdown, which is very hard to get out of. And I covered that in my first episode. Once trade size is controlled, something that may be counterintuitive, but is very powerful, starts to happen. And what happens is you don't have to win every trade. In fact, you can lose half your trades. You can lose more than half your trades and still be a very profitable trader. And we want to win as much as possible, but we know that's not possible. But understanding the math of trading and the math of risk management, again, we could lose half our trades and be very profitable. And just a hint there, it's reward to risk. If you've seen any of my videos before, my tagline has always been, keep your winners big and your losers small. And in the third video, I'm going to go into that in some more detail about how to set that up and to manage that in your trading. And the title is, you don't always have to be right. All right, hope to see you there. And there's some links at the end to some other videos that you might find useful as well. Thank you.